All right. Chapter 12 is on long-term liabilities, bonds, and notes. And so the focus of this is going to be on bonds. Bonds are a long-term debt instrument that is traded on an active market. All right? You can go out, just like you can buy stocks, you can go out into a brokerage account and buy bonds from a variety of issuers. Bonds are both public and private. Public bonds are school districts sell bonds. Northside Independent School District will sell a bond in order to build a new high school or middle school or elementary school. The city of San Antonio sells bonds. That's how we built the ACCT Center. That's how we built the Alamo Dome, is on bonds. The University of Incarnate Word sells bonds. We have bonds that we sell in order to finance upgrades to the facilities and the like. Okay? Corporations sell bonds. So AT&T sells bonds. General Electric sells bonds. The main difference between public and private bonds is that municipal bonds in particular are tax-free in the income. So if you go out and you buy a City of San Antonio bond, the interest that you're receiving is not taxable. So the bonds, therefore, tend to yield less than a corporate taxable bond in order to offset the effect of the taxes that you would have to pay. So bonds are long-term. They're in excess of a year. They can traditionally be 10, 15, 20 years. All right? They're ornate printed documents, and they have basic characteristics. All bonds will have a face value. They will have a face interest rate. They will have a term, how long until they mature. And they will pay either annual or semi-annual. So how often do you receive these interest payments? What else do they have? That's it. So they will have printed on the certificate this information. How much are they sold for? How much will they pay in interest? And how long will they last? And then how often will they pay this interest? Bonds have a yield. How much is the investors going how much are the investors going to receive from this investment? And they pay two forms of cash flows. They have this face value, cash at maturity, and they also have a interest. And this is normally semi-annual. Every 6 months, you're going to receive an interest payment. Now, bonds used to have coupons. Had little pieces of paper down at the bottom. Like, somebody advertising an apartment for rent here on campus. You go down, you tear off the little piece of paper and call the phone number or send a text to it. They used to use, you'd clip bond coupons. You'd go in there with a pair of scissors, you'd cut it out, put your name and address on the back of it, put it in a registered letter, send it off, return receipt requested, and they would turn around and send you a check. Now it's almost exclusively electronic now. So whoever the registered holder of the bond is. So the value that a bond has in order to determine its proceeds, the last thing you need to, you're going to take all of this information and you're going to figure out two things. How much will they sell for? And then the market rate. Which is also called the yield. Because it has a face interest rate, how much interest in cash it's paying you. But the market, when they sell and buy bonds, will determine, based upon these four pieces of information up here, how much they're willing to buy that bond for. Most bonds are in $1,000 increments. Most. Not all, but most. And if you go out to the Wall Street Journal and you look at the bonds that are selling at the close of business yesterday, they'll be priced as a percentage. So you'll see bond prices listed at 100 or 98 3/8 or 102 5/8. All that is a percentage of the face value. If it's selling at exactly 100%, that means a $1,000 bond is bought for $1,000. So how does the market pricing affect the yield? It does so by either increasing or decreasing the amount of cash that you have to outlay in order to get the cash stream back. All right? So the two things that you're always going to look at is what is the interest rate, the face interest rate, compared to the market rate. If the market rate is exactly equal, in other words, the open market, the trading market on bonds, has determined that the bond is paying exactly what they need. They're paying exactly the amount of interest in cash for a similar type risk. Because the higher the risk, the higher the yield. That makes sense, right? If you're going to risk more of your hard-earned money, then you better be getting back more from your investment. U.S. Treasury Securities are almost always, worldwide, the lowest yield. It's the safest investment. City of Detroit, maybe that might be a little higher because they're a high risk. They're in bankruptcy right now. Okay? So the higher the risk, the higher the yield. And it varies on an hour-by-hour basis throughout the day in and day out when the bond markets are open. So if the market determines that the bond face is not high enough, they will discount it. This means the face is less than the market. They're not giving you enough cash to entice you to make that investment. The interest rate's not high enough on the bond. So they're going to penalize you by giving you less than you want for the sale of the bond. But what if the interest rate on the bond was higher than the market wanted? Well, then it's a premium. Which means the face is higher than the market. You're being overly generous. You're paying them too much money. You're paying them more than they wanted. So they, in turn, are going to pay you more than you wanted. Does that make sense? It's logical. That's how the market forces adjust this yield on bonds. So let's look at a couple quick examples. Let's look at problems 21 and 22. Exercises 21 and 22 on page 576. So I'm going to put that over here. So exercise 12-21 on page 576. On this one, Pindler Company produces and sells high-quality video equipment. To finance its operations, they're going to issue $25 million of 5-year, 7% bonds with interest payable semi-annually. So the face value for this one is $25 million. They're paying 7% interest, 5 years, and it's semi-annual. It goes on to tell you that the market rate is 9%. So if the market needed 9%, but Pinker Company, when they set about getting approval and getting ready to sell these bonds, because you've got to go to the board of directors, and the board of directors sits there and takes the information, and they make a guess as to what the market's going to need. Because everybody always wants to get what they need. They want the $25 million when they sell this. So they designed it so that the market would accept a 7% yield. It takes months to do this. You've got to go find an underwriter, then you've got to advertise the bond sale, register it with the SEC, get it onto a market, and sell it. Takes a while. And it's a guess. They guessed wrong. The market on that day, when they released these $25 million out into the open market, needed 9% for a similar type investment vehicle. You're only paying 7%. So are they going to give you $25 million for that? No. They're going to penalize you. There's 2 cash flow streams. There's the $25 million, and then there's the interest payments. So these bonds are going to pay $875,000 every 6 months. And then at the end of 5 years, they're going to pay the full $25 million because the bonds mature. So you get your check for the whole face value of the bond when they mature. So what is that worth today on the date of the sale? Because $1 a year from now is not worth $1. Does everybody agree? If your crazy Uncle Mike gave you an IOU come Christmas time, you'd all be disappointed. Right? I'm going to give you $100. Great. Next year. Oh, thanks. Right? It's not worth the same as it is today. Because you can spend today's money rather than use your credit card and borrow it and incur interest on it. You could use the $100 to pay down your credit card and not incur interest on it. It's the same with companies and municipalities and states and governments. Money down the road is worth less than money today. So there's tables in the back of your book to help you with this. And they're in Appendix A, which is 2 pages after 751. So it's 753. Because it's just the page numbers are just A2 and A3. And there are 2 tables. There's the present value of $1 at compound interest due in N periods. And then the next table is the present value of an ordinary annuity. The difference is an annuity is the same cash flow over a period of time. This is an annuity. $875 in interest every 6 months for 5 years is an annuity because it makes up 10 payments. This is 1 payment. All right? And the only difference between the first table and the second table is the second table adds up all the factors in the first table for you, so you don't have to. Okay? So if you look at the first table in any column, and you look at the 2 factors, period 1 and period 2, add those 2 together and you'll get the second table. That's all that is. Because this is $875 1 period from now, and then another $875,000 2 periods from now, and then another one for 3, 4, 5, on and on and on for 10 periods. Okay? So when you're dealing with semi-annual, you're always going to have the interest rate, and you're going to double the years. So if you look at the table, half of 9% is 4.5%. So you're going to look in the 4.5% column, and because the final exam is open book, open note, because it's take home, write somewhere in your notes, use the market rate for looking up factors in the table. Put it somewhere, highlight it. Because what happens if you use the face rate? If you went and you looked up, well, first of all, there isn't a 3.5% column, so you know that it's not the 7%. Can't be. But if you were to look that up, what would happen is you'd find out the price of the bond was very, very close to $25 million. Because if the market rate and the interest in the face rate are exactly the same, it sells for 100 or par. It'll sell for the face value. That's not what the problem on the final exam will be, I can assure you. So if you look at the 4.5% in the first table, down to row 10, you find a factor of 0.64393. Which means that the $25 million payment in 10 periods 5 years, on a yield of 4.5% semi-annual, is really worth $16,098,250. That's what it's worth today. And if you took that and put it in your calculator and started multiplying that by 1.045, which is 4.5%, and you did that 10 times, you'd wind up with $25 million, or close. And when I get to the screen and show you this on the computer, your book table only displays this to 5 decimal places. So there's always going to be a little bit of rounding because it's only 5 decimal places. If you took the actual formula and you took it out to an unlimited number of decimal places, then it would equal exactly 25%. So the second one is that if you go to the next table and you look up under column 4.5 down to row 10, you get 7.91272. So that stream of 10 payments of $875,000 is worth $6,923,630. Add those 2 cash flow streams together, you get $23,021,880. That's the proceeds from the sale of a 5-year, $25 million bond, semi-annual payments with a face value of 7% when the market demanded 9%. So they penalized you because you were not paying enough. Excuse me, I'm a little hoarse today. Yes. Yes, thank you. It is. I went to the Virginia Tech Notre Dame game over the weekend. Sat in a stadium, 34 degrees, 20-mile-an-hour winds, and snow. Just pouring down snow. And then, of course, my Hokies won, so I'm a little hoarse from yelling and screaming at the top of my lungs because we wanted to make sure all 60,000 Notre Dame fans knew we were there. We succeeded. Okay, look at the next one, number 22. Exercise number 22 on the same page. On this one, Moss Company issues $42 million of 5-year, 11% bonds, semi-annual, and the market rate is still 9%. So on this one, it's $42 million, it's 11%, and it's still 5 years, times 2. The market rate is the same, so the factors are going to be the same. Only this is a $42 million issue, and it's paying $2,310,000. Yeah, because $42 million times 11% for the year is going to pay $5,620,000. Half of that every 6 months is $2,310,000. So that $42 million is really worth $27,045,060. And the annuity is worth $18,278,300. 383. Combine those two together, you get 45,323,443. A premium. Because the market only wanted 9%, but you, in your infinite generosity, gave them 11%. So they rewarded that generosity by giving you more money. Okay? All right. Has everybody got this? I'm going to turn the projector on, and I'm going to do the last part of this in Excel. We're going to do exercise number 12-25. In this one, Ware Company produces and sells motorcycle parts. On the first day of its fiscal year, they issue $35 million of 5-year, 12% bonds at a market interest rate of 10%. So they're giving 12%. The market only needed 10. So you know right away the proceeds are going to be higher than the face value. It's going to sell at a premium. Okay? If you go look up in tables at the Appendix A, the 10%, now which column are you going to look at? 12%, 6%, 10%, or 5%? 5%. Use the market rate. If you look at the 5% down to the row 10, you will see a factor of 61391. The next page on the annuity table, 7.72173. A 12% of $35 million will give you semi-annual cash of $2,100,000. Multiply those out. The 35 million times that factor is 21,486 and 16,215 for the annuity. So the second thing you need to understand is that when you then pay out this cash interest every 6 months, how much is the actual interest that the bond issuer is paying? Because this premium has to go from 37, they got extra, 2,702,483. That premium is going to be amortized over the life of the bond. Because in reality, they're only paying 10% interest, not the 12 that they're paying in cash. So their interest expense every 6 months is based on 5%, half of the 10% here. And this is how we do it. And I'm going to show this to you on both here and on the exam problem. Can't make that go from... See if all that fits. Close. Okay. On the date of the sale, you have a carrying value because the journal entry is going to be cash for $37,702,483. Bonds payable of $35 million, which is the face value of the note of the bond, and then premium on bonds payable of $2,702,483. That's the journal entry for the sale of the bond. Okay? Six months after the sale, you write the first check, $2,100,000, and send it to the bondholders. That's a debit to cash. All right? $2,100,000. Interest expense is based upon how much do you owe the bondholders, because during that first 6 months you owed them $37,702,483. You owed them all of it, times the rate that they demanded, which was only 10%. 6 months in, that's half. So if you multiply $37,702,000 by 6%, you get $1,885,124. The difference is $214,876. And that is the premium. Because at that first interest payment, they only wanted $1,885,000. You sent them $2.1 million. You overpaid them. So you use the overpayment to lower the debt. So the debt, the total amount that you owe, the bonds payable plus the premium on bonds payable, goes down by that overpayment of $214,876. Now you only owe them $37,487,607. You don't owe them as much money. So when the next 6 months goes by and you're ready to write another check for interest, now you only have interest expense of $1,874,000. You don't owe them as much money, so you don't have as much interest expense. Now your overpayment is even more because you didn't owe them as much interest, but you still sent them a check for $2.1 million in cash. Now your overpayment is $225,620. Lower the debt. You do that every 6 months until at the end you owe the bondholders $34,999,798. And that's the face value of the bond, the $35 million. You write them a check. Now you don't owe them anything else, and the bond is dissolved. It's redeemed. And the reason this is off by $202 is because the factor is limited to 5 decimal places. If I do this same exact problem and I take the decimal places out to as many as it needs, it's really not a factor of 61391, which is what was in the book. It's really a factor of 613,913,254. And the proceeds are not really $37,702,483. They're 607 rather than 483. You amortize that number by multiplying it by 5% each time, and you see it comes down to exactly $35 million at the end. All right? So it's just rounding. So when you're doing a problem such as this on your final exam, don't panic when you get to the bottom and it's not exact. You didn't do anything wrong. If it's close, if it's within $300-400, you're good. You're golden. It's not, you've done it right. Okay? So this was the amortization of a premium. What's the amortization of a discount? The very next problem. Number 26 is Boyd produces and sells aviation equipment. They issue $80 million of 5-year bonds at a 9% interest rate where the market needed 12. So here's a discount. Oh, hold on, the factors are going to change. No, they aren't. It's the same because it's still 5 years and it's still an, I'm sorry, 12%. So let's see, 26. The factor for this one, oh, okay. It's this. Yeah. All right, it works. So what happens here? You multiply times 6%, which is half of the effective interest rate, and you get $4,270,000. All right? You actually sent them only 3.6. So you have underpaid them by $670,000. Now you owe them that money. The amount that you owe them goes up. Whereas when you were amortizing a premium, it was going down because you were overpaying them. Now you're not paying them enough. All right? And you keep underpaying them month after every 6 months, and then you get down to, once again, the $80 million. All right? Does this make sense on a bond? Yes? If it doesn't, let me know. Okay. Let me turn this off, and I